What if I told you there is a company sitting right now on the public stock market, available for anyone with a brokerage account to buy before the market opens tomorrow morning, that has already conquered a multi-billion-dollar industry, holds over 80% of its entire global market, generates more than $10 billion in annual revenue, just posted 20% year-over-year growth, carries over 10,700 active robotic systems deployed at hospitals across the world, and is directly plugged into what Wall Street is now calling the single greatest investment theme of the next decade? And what if I told you that most retail investors, the people scrolling their phones right now looking for the next hot robotics play, have absolutely no idea this company even exists in the robotics space? They are out there chasing pre-revenue humanoid robot startups and speculative meme stocks, while one of the most defensible, most profitable, most AI-driven robotics platforms on Earth sits right in front of them, hiding in plain sight. Stay with me, because what I am about to walk you through is not hype. It is not speculation. It is not a gamble on some startup burning through venture capital money with no product and no revenue. This is a cold, data-backed, numbers-driven argument for why one specific AI robotics stock deserves to be in your portfolio right now, and why the window to get in at a reasonable price may be closing faster than most people realize. Let me start by setting the scene, because context is everything when it comes to investing. We are living through one of the most significant technological shifts in human history. I do not say that to be dramatic. I say it because the data demands that conclusion. Every generation has its defining technological revolution: electricity, the automobile, the transistor, the personal computer, the internet, the smartphone. Each of those revolutions, without exception, created enormous generational wealth for the people who recognized the shift early, understood the implications clearly, positioned themselves correctly, and had the conviction to hold on long enough to see the world reorganize itself around the new technology. The people who bought Microsoft before Windows went mainstream. The people who bought Amazon when Wall Street was still calling it an expensive bookstore. The people who bought Apple before the iPhone existed. Those investments looked risky in the moment. The pundits were skeptical. The valuations seemed stretched. But in hindsight, of course, they look like the most obvious decisions in the world. Right now, in early 2026, we are standing at that exact same kind of crossroads, with artificial intelligence and robotics. And the crowd has not fully arrived yet. Think about what is actually happening in the physical world around you right now, not in some speculative future, but today. Warehouses are deploying fleets of autonomous robots to move hundreds of thousands of product orders every single day. Agility Robotics' Digit system is already operating inside Amazon and GXO logistics facilities right now, not in a lab, not in a pilot program, but in live commercial operations. Figure AI is testing humanoid robots at BMW's factory in Spartanburg, South Carolina. Approximately 16,000 humanoid robots were installed globally in 2025 alone. Global robotics funding surpassed $10.3 billion in 2025, the highest funding level since 2021. Chinese manufacturers recorded over 610 separate robotics investment deals in just the first 9 months of last year. The machines are not a future event. They are already here, already working, already scaling at a pace that nobody predicted even 3 years ago. And the financial projections are staggering. Goldman Sachs has revised its humanoid robot market projection to $38 billion by 2035. More than 6 times what their previous estimate was, and they specifically moved that number up because AI development has accelerated far beyond what their models initially predicted. Morgan Stanley has gone even further, projecting the total humanoid robotics market could reach $5 trillion by 2050. Fortune Business Insights estimates the global humanoid robot market was nearly $5 billion in 2025 and projects it will explode to over $165 billion by 2034, a compound annual growth rate above 50%. Research Nester puts the overall humanoid robot market at over $3 billion in 2025 and projects it will reach over $81 billion by 2035. The exact number varies depending on which analyst or research firm you consult, but every single projection points in the same direction: explosive, sustained, multi-decade growth. The word growth does not even feel adequate. This is a sector that is transforming from a footnote in technology reports into one of the dominant economic forces of the coming century. But here is where I see most investors making a critical and costly mistake. When people hear AI robotics, they immediately think of the shiny stuff: humanoid robots doing backflips on stage at CES, Tesla's Optimus program, Boston Dynamics' newly electric Atlas robot entering commercial production, with Hyundai revealing plans to manufacture 30,000 units annually by 2028. And yes, those are genuinely exciting developments. Yes, some of those companies will create enormous wealth for investors over the coming decade. But right now, today, in early 2026, most of those pure-play humanoid robot companies are either pre-revenue, pre-IPO, or burning through capital at rates that make near-term profitable investing extremely challenging and speculative. You are essentially making a long-duration bet on a technology that is still proving itself commercially, with deployment timelines that are notoriously difficult to predict. The smarter near-term play, the play that gives you genuine, meaningful AI robotics exposure backed by real revenue, real earnings, real market dominance, and a recurring business model that compounds over time, is the stock I want to talk to you about today. And it is probably not the name you were expecting to hear. That company is Intuitive Surgical, ticker symbol ISRG on the NASDAQ. I know what some of you are already thinking. You have heard of Intuitive Surgical? You know what makes surgical robots? You probably think of it primarily as a healthcare company or a medical device company, not an AI robotics company. And that is precisely the misconception I want to dismantle right now, because it is that mental category error, shared by millions of retail investors, that may be creating one of the most interesting opportunities in the market today. Intuitive Surgical is one of the most powerful artificial intelligence and robotics platforms on Earth. It just happens to be deployed in operating rooms rather than warehouses or factory floors, and that distinction matters enormously for investors, because operating rooms are one of the most defensible, most recurring, most legally protected, and most difficult to disrupt markets that exist anywhere in the global economy. When a hospital spends $1 to $2 million to install a Da Vinci surgical system, trains its surgical teams on that system over months of rigorous clinical education, certifies its entire staff on the platform, and builds its procedural workflows, its scheduling systems, and its patient communication around that technology, it does not rip that system out and replace it with a competitor's product. The switching costs are enormous in every dimension: financial, operational, regulatory, and clinical. The retraining requirements are substantial, the regulatory recertification process is extensive, and the clinical outcomes data that justifies the platform's existence is backed by over 500 peer-reviewed scientific publications across dozens of procedure types and patient populations. This is not a software-as-a-service company that loses a customer the moment a competitor offers a 10% discount on their annual subscription. This is a deeply embedded, clinically validated, critically important piece of hospital infrastructure that, once installed, generates revenue continuously for years and potentially decades. Let me give you the full financial picture, because the numbers here are genuinely extraordinary, even for a company of this size and maturity. In full year 2025, Intuitive Surgical reported total revenues of $10.1 billion. That is a 20.5% increase compared to 2024, a growth rate that most technology companies would celebrate, let alone a company operating in the highly regulated, capital-intensive medical device space. Adjusted earnings per share came in at $8.93, up 21.7% year over year. The company's robotic surgery systems were used to treat more than 3.1 million patients globally in 2025. That is an 18% increase over the prior year. Think about that number. 3.1 million human beings had their surgeries performed with the assistance of Intuitive Surgical's AI-powered robotic systems in a single year. That is not a projection. That is not a hope. That is a fact, reported in official earnings disclosures filed with the Securities and Exchange Commission. The Instruments and Accessories segment, which is the recurring high-margin revenue stream generated every single time a Da Vinci system is used for any procedure, posted 18.5% growth in 2025. And in the fourth quarter of 2025 specifically, the company placed 532 new Da Vinci surgical systems, including 303 of its newest flagship platform, the Da Vinci 5. Revenue in Q4 2025 came in at approximately $2.87 billion, reflecting a 19% increase year over year. The company is guided for worldwide Da Vinci procedure growth of approximately 13 to 15% in 2026. On an installed base of over 10,700 systems, 13 to 15% procedure growth represents an absolutely massive volume of additional surgeries, and every single one of those surgeries generates instrument and accessory revenue for Intuitive Surgical. The consensus estimate among Wall Street analysts is for 2026 earnings per share of approximately $9.61, a 12% increase from 2025, and sales growth of approximately 12.7%. Now, let me explain the business model in detail, because once you truly understand how this company makes its money and why the economic structure is so uniquely powerful, everything else about this investment thesis falls into place. The foundation of Intuitive Surgical's economic engine is what investment analysts call the installed base flywheel. The company sells or leases Da Vinci surgical systems to hospitals. These are high-value capital equipment placements ranging from roughly $1 million to over $2 million per unit, depending on the configuration and the lease arrangement structure. But the sale or lease of the system itself is not where Intuitive generates the majority of its revenue or its profitability. The real engine of the business, the part that makes this company truly extraordinary as an investment, is the instruments, accessories, and services revenue that flows from those installed systems on every single procedure performed for the life of those systems. The instruments used in da Vinci procedures are proprietary, single-use, or limited use, and cannot be substituted with third-party alternatives. Every instrument pack, every accessory, every disposable component used in every surgery must be purchased from Intuitive Surgical. This means that every system the company successfully places at a hospital becomes a permanent, locked-in, recurring revenue stream that generates income on every case performed, effectively forever, or at least until the system is eventually upgraded with the next generation platform, at which point Intuitive simply works with the hospital to transition to a new system, and the cycle continues and accelerates. Consider what that means at the scale this company now operates. Over 10,700 systems globally, each system performing multiple procedures every week, each procedure generating instrument and accessory revenue. Multiply that across 3.1 million patients treated in 2025, and you begin to understand why Intuitive's instruments and accessories revenue has become one of the most durable recurring revenue streams in all of technology. As the installed base grows, the procedure volume grows. As the procedure volume grows, the recurring revenue base grows. As the recurring revenue grows, the company generates more cash to invest in research and development, global expansion, and new system development. Each new system placement does not just generate one-time revenue, it locks in a stream of future recurring revenue that compounds the total value of the installed base. The flywheel spins faster with every placement, and it has been spinning for 26 years. The da Vinci 5, the company's newest and most advanced platform, is not just an incremental product refresh designed to maintain market share. It is a genuinely transformative piece of technology that represents the fullest integration of artificial intelligence into clinical robotic surgery that has ever been commercially deployed. The da Vinci 5 features AI-powered force gauge visual indicators, a technology that gives the operating surgeon real-time, quantified, AI-processed feedback on exactly how much pressure they are applying to tissue at every moment during a procedure. That kind of tactile intelligence, communicated through machine learning algorithms processing live sensor data from the robotic instruments, has never existed before in any commercially deployed surgical robotic system. The platform also includes in-console video replay capabilities that allow surgical teams to review specific maneuvers in real time during a procedure, essentially giving surgeons the ability to learn from their own technique and immediately refine their approach while they are still in the operating room. And the enhanced force feedback technology creates a haptic sense of tissue resistance that dramatically reduces the risk of applying too much or too little force during the most delicate surgical maneuvers. This is not a robot executing a pre-programmed sequence of repetitive movements. This is a robot with embedded artificial intelligence actively augmenting human clinical decision-making in the highest stakes environment imaginable, live surgery on a conscious human being under general anesthesia, where errors can be fatal and precision is not just preferred but required. And it is doing so at scale in thousands of hospitals across dozens of countries, on millions of patients right now. The expansion of the da Vinci 5's clinical application is also accelerating, at a pace that many investors have not yet internalized. In December 2025, the FDA cleared the da Vinci single-port system for 3 additional high-volume general surgery procedures: inguinal hernia repair, cholecystectomy, and foregut procedures. That same month, the da Vinci 5 received FDA clearance for use in cardiac procedures, including mitral valve repair and internal mammary artery mobilization for cardiac revascularization. Management has estimated that this cardiac clearance alone expands the total addressable market by approximately 160,000 additional procedures annually. New features and expanded indications are expected to continue throughout 2026 as Intuitive pushes the da Vinci 5 into new surgical specialties, including elements of spine surgery, head and neck surgery, and advanced gastrointestinal and oncological procedures. Geographically, the growth opportunity is equally compelling. In Japan, potential reimbursement coverage for additional robotic procedures is expected to be granted by mid-2026, which could trigger a significant acceleration in adoption across one of the world's largest and most sophisticated healthcare markets. Intuitive is actively building out direct commercial operations in Italy, Spain, and Portugal. It is expanding its training infrastructure across Southeast Asia. And even in China, where procedure volumes have faced some near-term headwinds due to regulatory and reimbursement complexities, the long-term structural trajectory remains strongly positive as the country's healthcare system continues its modernization and as demand for premium surgical outcomes grows with the expanding middle class. The analyst community's response to Intuitive Surgical's recent results and guidance has been overwhelmingly and consistently positive. In the weeks immediately following the company's Q4 2025 earnings release in January 2026, Goldman Sachs raised its price target on ISRG to $714, up significantly from $621. Barclays raised its price target to $686 and maintained a buy rating. BTIG raised its target to $616. Truist raised its target to $650. RBC Capital maintained its buy rating and raised its price target. Wells Fargo maintained its buy rating. Robert W. Baird reaffirmed its buy rating. According to aggregated analyst data, the average 12-month price target from 14 analysts covering the stock represents approximately 25% upside from recent trading levels. This is not a situation where one or two outlier analysts are skewing the average. The consensus across the street is genuinely, broadly, and consistently bullish in a way that rarely characterizes any single stock. But I believe in giving you the complete picture rather than cherry-picking only what makes the investment look attractive. So let me address the risks directly, because they are real and they deserve honest acknowledgement. The stock trades at a premium valuation, a forward price-to-earnings ratio of roughly 47 to 55 times, depending on the estimate period and the analyst. That is meaningfully above both the healthcare industry average and the broader S&P 500. If procedure growth slows materially below management's guidance, or if a serious, well-funded competitor emerges with clinically validated technology that can challenge the Da Vinci platform's dominance at the hospital level, the stock could face significant multiple compression. In China, regulatory uncertainty and reimbursement challenges have created some near-term headwinds that management has acknowledged explicitly. Tariffs on imported medical equipment represent a modest but real margin headwind. Management has estimated approximately a 70 basis point impact on 2025 margins from tariff exposure. And while Intuitive's manufacturing operations are primarily based in the United States and Mexico, providing some insulation from the most severe tariff scenarios, global supply chain dynamics add a layer of uncertainty that cannot be entirely dismissed. The valuation also leaves relatively little room for execution errors. If the company misses guidance materially, the premium multiple could compress quickly. Additionally, while no competitor has yet built a clinical track record that can match the Da Vinci platform, the surgical robotics space is no longer without challengers. Medtronic, Johnson & Johnson, and several well-funded startups are actively developing competing robotic surgical platforms. The competitive landscape will intensify over time. Maintaining 80% market share in perpetuity in any technology market would be an extraordinary achievement. These risks are real. Every serious investment involves risk. But in the context of the complete investment thesis, the financial performance, the business model durability, the installed base defensibility, the AI integration, the geographic expansion opportunity, and the vast remaining penetration of global surgery, I believe the risk-reward profile here is genuinely compelling. And there is one dimension of this story that I believe is genuinely and significantly underappreciated by most investors: the sheer scale of the remaining untapped opportunity. Here's a number that should put everything in perspective. The vast majority of surgical procedures performed globally every single day are still performed without any robotic assistance whatsoever. Robotic surgery, for all of its 26 years of growth and expansion, still represents a relatively small percentage of the total global surgery market. The procedure categories where Da Vinci has established its strongest current penetration, prostatectomy, hysterectomy, colectomy, nephrectomy, are meaningful but represent only a fraction of the total surgical universe. Cardiac surgery, spine surgery, orthopedic procedures, thoracic procedures, head and neck surgery, advanced oncological resections, hernia repair at global scale. These are massive, high-volume procedure categories where robotic assistance could dramatically improve outcomes, reduce recovery times, lower complication rates, and reduce the total cost per treatment episode for healthcare systems operating under enormous financial pressure. And Intuitive Surgical is systematically, methodically, clearance by clearance, indication by indication, working its way into every one of those categories with the full force of the most advanced AI-powered surgical platform ever built. When you combine that expansion of clinical indications with the company's global geographic growth trajectory, its new AI-powered Da Vinci 5 platform driving adoption of the next generation system, its Ion endoluminal system growing at over 50% annually in lung biopsy procedures, and its deeply embedded installed base generating recurring revenue on every single case performed anywhere in the world, you have the makings of one of the most compelling compounding investment machines available to public market investors today. And all of this is happening at exactly the moment when the broader world is waking up in a rapid and irreversible way to the transformational potential of artificial intelligence in physical robotic systems. The same advances in machine learning and computer vision that are making Tesla's Optimus robot more capable are also making Intuitive's Da Vinci 5 more capable. The same force feedback research, the same embodied AI development, the same sensor fusion technologies that researchers are applying to warehouse robots and humanoid platforms are finding their way into surgical systems. The entire field of robotics and AI is cross-pollinating and accelerating simultaneously across every application domain. Intuitive Surgical is not an isolated player in a narrow medical niche. It is an active and advanced participant in the broader AI and robotics revolution, operating in a segment that is more defensible, more profitable, more clinically validated, and more durably competitive than virtually any other segment of that revolution. Now, I want to take a step back from Intuitive Surgical specifically and talk about the broader landscape of the AI robotics investment opportunity, because I think it provides essential context for understanding why this particular stock matters so much right now. The robotics industry is experiencing something that market observers are calling an inflection point, a moment where the combination of converging technologies, structural economic pressures, and massive capital investment creates a phased transition from gradual linear growth to exponential acceleration. We have seen this pattern before in technology. It happened with semiconductor chips in the 1980s. It happened with the internet in the mid-1990s. It happened with smartphones in 2007. In each case, the convergence of better components, lower costs, enabling software, and strong demand created a moment where adoption went from niche and experimental to mainstream and irreversible almost faster than analysts could update their models. That is what is happening right now in robotics. And the specific forces driving it are worth understanding in granular detail because they are not going away. First, consider the labor shortage crisis. This is not a problem that exists in one country or one industry. It is a global structural phenomenon driven by irreversible demographic change. Japan's working-age population has been shrinking for 2 consecutive decades. Germany faces a projected shortfall of 7 million skilled workers by 2035. China's manufacturing workforce peaked in 2017 and has been in structural decline since. In the United States, the warehouse and logistics sector faces annual employee turnover rates that often exceed 100%, meaning operators must hire and fully retrain their entire workforce essentially every 12 months just to maintain current operations. Hospitals across the developed world cannot find enough nurses, surgical technicians, or healthcare support staff to meet the demand of aging patient populations. Elder care facilities in Japan, South Korea, and across Europe are in desperate need of caregivers to support the fastest growing segment of their populations. These are not situations that resolve themselves when economic conditions improve. These are structural gaps created by the irreversible mathematics of population aging and demographic decline. The workforce shortfalls of today will be the workforce catastrophes of tomorrow, unless something fundamentally changes in how human civilization approaches the organization of labor. And robotics, AI-powered, adaptive, increasingly affordable robotics, is the only technological solution that scales to meet that demand. Second, consider what has happened to the cost of robotic hardware. Goldman Sachs reported in 2025 that manufacturing costs for humanoid robots declined 40% year over year, far faster than prior analyst projections of 15 to 20% annually. Chinese manufacturer Unitree launched a functional humanoid robot in July 2025 at a price of just $5,900, a price point that the entire industry had assumed was years away from being achievable. Tesla is targeting a $20,000 to $30,000 price point for its Optimus robot at commercial scale. Robot-as-a-service models are emerging where companies can deploy robotic workers on a per-hour or per-task basis, eliminating the large upfront capital requirement entirely. These cost dynamics mean that the economics of robotic automation are rapidly shifting from capital-intensive and accessible only to large enterprises to broadly deployable across businesses of all sizes. Third, consider the software layer. The integration of large language models, computer vision systems, and reinforcement learning algorithms into robotic control systems has fundamentally changed what robots can do and how quickly they can learn to do new things. Robots that previously required months of careful programming to execute a specific task sequence can now learn new tasks through demonstration and natural language instruction in ways that would have seemed like science fiction 5 years ago. This is precisely why Goldman Sachs and Morgan Stanley have dramatically revised upward their market projections. The AI breakthrough is not just making robots smarter, it is making them generically useful in a way that dramatically expands the total addressable market. All of these forces, demographic pressure, collapsing hardware costs, and revolutionary AI software, are converging simultaneously. And the convergence is happening faster than any major financial institution's models initially predicted. We are not talking about a gradual, predictable, linear expansion of robotics. We are talking about an exponential acceleration that is only just beginning to reveal itself in the market data. Against this backdrop, what makes Intuitive Surgical such a compelling investment is not just the company's individual financial performance. Impressive as that performance undeniably is. What makes it compelling is the combination of that financial strength with the structural tailwinds of the broader robotics revolution. Every force that is driving the expansion of robotics globally, the need to do more with less human labor, the integration of AI into physical systems, the demand for precision and consistency beyond human capability. Every one of those forces is also a tailwind for robotic surgery specifically. Surgical procedures that currently require highly trained specialist surgeons who take years to develop their skills could increasingly be augmented or, in some cases, guided by AI-powered robotic systems that help standardize outcomes across skill levels. Healthcare systems under financial pressure are actively looking for ways to reduce per-procedure costs and variability, and robotic surgery with standardized protocols and reduced complication rates delivers measurable value on both of those dimensions. The ION system is also a story that deserves more attention from investors than it currently receives. The ION system is also a story that deserves more attention from investors than it currently receives. ION is Intuitive's robotic endoluminal platform for minimally invasive lung biopsy, a system that allows physicians to navigate a flexible catheter through the complex branching geometry of the lung's airways and collect biopsy samples from lesions that would otherwise require more invasive surgical procedures or would simply not be biopsied at all due to access difficulty. ION procedures grew approximately 51% in 2025. That growth rate on a platform that is still in its early adoption phase suggests that Intuitive is not simply defending its existing Da Vinci territory. It is actively opening entirely new clinical categories where robotic platforms can create value that previously did not exist. The lung cancer detection and diagnosis market is enormous. An early detection of malignant lesions through minimally invasive ION procedures could translate into dramatically better patient outcomes while generating meaningful incremental revenue for Intuitive. Let me bring this entire argument together with the most important framing I can offer. The history of technology investing is full of cautionary tales. Not just stories of people who missed the opportunity entirely, but stories of people who recognized a genuine revolution and still lost money by chasing the wrong companies within that revolution. When the internet was emerging in the late 1990s, the opportunity was absolutely real. The internet did change everything. It transformed commerce, communication, entertainment, finance, and virtually every dimension of human economic activity. But the vast majority of the companies that attracted the most attention, the most speculative capital, and the most breathless media coverage during that period went to zero. They were real companies working on real technology in a genuinely transformative space. They just had no durable business models, no real competitive moats, and no path to sustainable profitability. The companies that created generational wealth for investors were the ones with real recurring revenue, real defensible advantages, and the ability to compound their position over time. Amazon, Google, eventually Apple. These were not the flashiest stories of the late 1990s, but they were the ones that endured. The same pattern is playing out right now in the AI robotics revolution. The opportunity is absolutely real. The data is overwhelming. The demographic forces driving automation are structural and demographically irreversible. Global population aging, workforce shrinkage, labor cost escalation, and the widening gap between the demand for human labor and the available supply of it in manufacturing, logistics, healthcare, and elder care. These are not cyclical problems that recover with the next economic expansion. They are permanent structural realities. But within this revolution, there will be companies that create enormous wealth and companies that consume enormous capital while delivering very little to the investors who funded them. The winners will be the companies that combine genuine AI and robotics capability with defensible business models, recurring revenue, sustainable profitability, and the ability to compound their competitive advantage over time. Intuitive Surgical has all of those characteristics. $10.1 billion in revenue, 20% year-over-year growth, 3.1 million patients treated in 2025 alone, over 10,700 systems generating recurring revenue globally, a new AI-powered platform receiving expanding FDA clearances at an accelerating rate, an installed base model that has never been disrupted in 26 years of commercial operation, a Wall Street analyst consensus that is uniformly and consistently bullish, a remaining untapped market that dwarfs everything the company has captured to date, and a total business system, the hardware, the software, the instruments, the training infrastructure, the clinical data, the regulatory relationships, the surgeon education ecosystem, that would take any competitor a decade or more and billions of dollars of investment to even partially replicate. This is the AI robotics company I'm buying before 2026 is over. Not because I am speculating on a future that might or might not materialize, not because I am chasing a trend that has already played out, but because the future is already here, it is already profitable, it is already scaling, it is already compounding, and the market, in my view, has still not fully priced in what this company is capable of delivering over the next 5, 10, and 20 years. When the window is open, the data is clear, the business model is proven, the technology is advancing, the market is expanding. And the analysts who cover this space most closely are almost universally telling you the same thing. The only question left is whether you're going to act on it before it is too obvious to everyone. ION is Intuitive's robotic endoluminal platform for minimally invasive lung biopsy, a system that allows physicians to navigate a flexible catheter through the complex branching geometry of the lung's airways and collect biopsy samples from lesions that would otherwise require more invasive surgical procedures or would simply not be biopsied at all due to access difficulty. ION procedures grew approximately 51% in 2025. That growth rate on a platform that is still in its early adoption phase suggests that Intuitive is not simply defending its existing Da Vinci territory. It is actively opening entirely new clinical categories where robotic platforms can create value that previously did not exist. The lung cancer detection and diagnosis market is enormous, and early detection of malignant lesions through minimally invasive ION procedures could translate into dramatically better patient outcomes while generating meaningful incremental revenue for Intuitive. Let me bring this entire argument together with the most important framing I can offer. The history of technology investing is full of cautionary tales, not just stories of people who missed the opportunity entirely, but stories of people who recognized genuine revolution and still lost money by chasing the wrong companies within that revolution. When the internet was emerging in the late 1990s, the opportunity was absolutely real. The internet did change everything. It transformed commerce, communication, entertainment, finance, and virtually every dimension of human economic activity. But the vast majority of the companies that attracted the most attention, the most speculative capital, and the most breathless media coverage during that period went to zero. They were real companies working on real technology in a genuinely transformative space. They just had no durable business models, no real competitive moats, and no path to sustainable profitability. The companies that created generational wealth for investors were the ones with real recurring revenue, real defensible advantages, and the ability to compound their position over time. Amazon, Google, eventually Apple. These were not the flashiest stories of the late 1990s, but they were the ones that endured. The same pattern is playing out right now in the AI robotics revolution. The opportunity is absolutely real. The data is overwhelming. The demographic forces driving automation are structural and demographically irreversible. Global population aging, workforce shrinkage, labor cost escalation, and the widening gap between the demand for human labor and the available supply of it in manufacturing, logistics, healthcare, and elder care. These are not cyclical problems that recover with the next economic expansion. They are permanent structural realities. But within this revolution, there will be companies that create enormous wealth and companies that consume enormous capital while delivering very little to the investors who funded them. The winners will be the companies that combine genuine AI and robotics capability with defensible business models, recurring revenue, sustainable profitability, and the ability to compound their competitive advantage over time. Intuitive Surgical has all of those characteristics. $10.1 billion in revenue, 20% year-over-year growth, 3.1 million patients treated in 2025 alone, over 10,700 systems generating recurring revenue globally, a new AI-powered platform receiving expanding FDA clearances at an accelerating rate, an installed base model that has never been disrupted in 26 years of commercial operation, a Wall Street analyst consensus that is uniformly and consistently bullish, a remaining untapped market that dwarfs everything the company has captured to date, and a total business system, the hardware, the software, the instruments, the training infrastructure, the clinical data, the regulatory relationships, the surgeon education ecosystem that would take any competitor a decade or more and billions of dollars of investment to even partially replicate. This is the AI robotics company I'm buying before 2026 is over. Not because I am speculating on a future that might or might not materialize, not because I am chasing a trend that has already played out, but because the future is already here, it is already profitable, it is already scaling, it is already compounding, and the market, in my view, has still not fully priced in what this company is capable of delivering over the next 5, 10, and 20 years. The window is open, the data is clear, the business model is proven, the technology is advancing, the market is expanding, and the analysts who cover this space most closely are almost universally telling you the same thing. The only question left is whether you're going to act on it before it is too obvious to everyone.